Something deeply unsettling is unfolding across the United States. Whole communities are slowly falling apart, not with explosions or headlines, but with a quiet, creeping decay. Streets that once rang with children's laughter now sit in eerie silence, lined with abandoned homes and lawns consumed by weeds. This isn't just a market slowdown, it's a full-scale collapse. Construction crews have vanished, home buyers nowhere to be found, and property values, they're plunging faster than most people are willing to admit. Families are packing up and leaving cities that once felt like the future, places that held hope, jobs and stability. But now those cities are shedding jobs, economic engines are sputtering, and the once bright promise of the American dream is fading with every new foreclosure. What's coming isn't a soft landing. It's a financial landslide, a brutal storm that's about to reshape how Americans think about home, safety, and stability. Number 10. Washington. The housing market in Washington isn't simply slowing down, it's beginning to rot from within. Cities like Seattle, Bellevue, and Tacoma once thrived on a tech-fueled high, with companies like Amazon, Microsoft, and Boeing pouring in thousands of workers who drove home prices into the stratosphere. In some parts of King County, the median home now hovers above $800,000, an insane figure by any standard. But the party's over. With tech giants slashing jobs and companies pulling employees back into the office, the illusion is fading fast. Listings are piling up. Housing inventory has surged 21% compared to last year, while home sales have plunged to their lowest point since 2011. Buyers have all but disappeared. Sellers are growing desperate. And the cracks? They're starting to split wide open. By 2025, mortgage rates averaging 6.8% mean the typical Seattle buyer is staring down monthly payments north of $4,800, a massive leap from just $2,900 3 years ago. On top of that, property taxes are up 14%, and maintenance costs have jumped nearly 18%, tacking on another $1,600 a month to already maxed-out budgets. Even those once thought untouchable, high-paid tech professionals are quietly defaulting on loans. Nearly 1 in 5 homes on the market are seeing price cuts in the tens of thousands just to draw a handful of showings. But this goes deeper than housing. Washington's economy is dangerously dependent on just 2 engines, tech and aerospace, both of which are known to bleed heavily during downturns. Boeing's slowed production, Amazon's hiring freezes, and sweeping layoffs across the startup scene have drained local demand. Add to that a rise in crime and homelessness, especially in once prized Seattle neighborhoods, and it's no wonder families are leaving. In Spokane, home values slid 3.2% in just 1 quarter. In Yakima, listings doubled, but buyers practically non-existent. If a recession strikes, and many believe it will, Washington's housing market is poised to collapse faster than most are ready for. The state once rode high on tech ambition. Now, it's staring down the consequences of tech abandonment. With rising costs, stagnant population growth, shrinking remote work options, and collapsing buyer confidence, this isn't just a correction, it's a perfect storm. When Washington's bubble finally bursts, it won't be a soft slide, it'll feel like a freefall into economic darkness. Number 9. Nevada. Nevada's housing surge wasn't built on solid ground, it was propped up by illusion, hype, and borrowed momentum. For years, Las Vegas stood as the shining symbol of unlimited expansion. Towering developments, non-stop construction, and investors flipping properties at lightning speed made it feel unstoppable, like a never-ending party under flashing lights. But when the economy cools and tourism takes a hit, that illusion evaporates quickly. In 2025, the median home price in Nevada hovers around $455,000. Yet behind that number is a sobering reality. Home sales have dropped by 18% year over year, while active listings have surged 23%, leaving over 15,000 properties languishing on the market. Take a drive through the suburbs of Henderson or North Las Vegas, and you'll see for sale signs lined up like dominoes, whole neighborhoods waiting for buyers who never show up. The issue isn't just inflated prices, it's that the average person simply can't afford to buy anymore. With mortgage rates steady around 6.7%, monthly payments now exceed $3,600 for a typical home. Add to that a 22% spike in property insurance across Clark County, and the burden becomes crushing. The broader economy isn't helping. Casino job cuts, sluggish tourism, and fewer conventions mean less money in circulation. And for a state like Nevada, which depends almost entirely on discretionary spending, that's a recipe for disaster. When visitors stop coming, tip income disappears, service industry jobs vanish, and mortgage defaults start stacking up. The speculators who once treated Vegas real estate like a high-stakes game are heading for the exits. Nearly 1 in 4 sellers are slashing their asking prices, and homes now sit on the market for an average of 68 days, the longest stretch since 2012. Even builders are waving the white flag. Just a couple of years ago, they couldn't construct homes fast enough. Now they're offering $30,000 incentives just to get properties off their hands. It's a brutal reversal that's starting to feel all too familiar, a rerun of 2008, but this time the stakes are even higher. Layer in soaring inflation, extreme weather, and deepening water shortages in southern Nevada, and you've got a market that's becoming nearly impossible to sustain. Restrictions on water use are driving up development costs and turning away future investment. Sure, Las Vegas still sparkles after dark, but behind the neon there's a graveyard of empty homes, stalled projects, and broken dreams. And when the national economy starts to sneeze, Nevada doesn't just catch a cold, it goes straight into economic pneumonia. The bubble here isn't just leaking, it's bursting, and no jackpot, no matter how big, can stop what's coming. Number 8. Utah. Utah's once celebrated real estate boom, hailed as a decade-long miracle, is unraveling at a pace almost as alarming as its disappearing mountain snowpack. For years, the Silicon Slopes corridor, anchored by tech hubs in Lehigh, Draper, and Provo, was marketed as the next great land of opportunity. But in 2025, that promise is collapsing fast and hard. This state was once one of the hottest markets in the nation. Median home prices soared past $560,000, marking a staggering 70% increase since 2019. But now, the momentum has flipped, with tech layoffs sweeping the state and mortgage rates sitting uncomfortably above 6.5%. Buyers have effectively vanished. Home sales have plunged 19% year over year, while listings have surged 28%, flooding the market with unsold properties that are lingering longer and longer. In Salt Lake City, the average home now sits on the market for 71 days, a far cry from just 29 days during the pandemic-era buying frenzy. Builders, once racing to keep up, are now pulling the plug on projects, and price cuts are spreading across the Wasatch Front like an unstoppable avalanche. Roughly 1 in 4 listings has already seen major price drops, a loud and clear sign that desperation is setting in. But the real crisis goes deeper. Affordability has broken down completely. Household income simply hasn't kept pace. The average mortgage now eats up 42% of a family's earnings, and when you factor in utility bills and maintenance costs, both of which have jumped 17% this year, the math no longer adds up for most Utahns. And it's not just about finances. Water shortages, declining air quality, and increasingly crowded suburbs are making the state less livable by the day. Population growth, once Utah's key advantage, is beginning to stall as more residents flee the rising costs and deteriorating quality of life. The tech sector, which once acted as the engine of prosperity here, is now sputtering. Major players like Adobe, eBay, and countless startups are either downsizing or shifting operations out of state. And as demand collapses and speculative investors flee the scene, the so-called Silicon Slopes are starting to resemble housing sinkholes instead. If the broader U.S. economy dips into recession, Utah's housing market won't just wobble, it will likely crumble under its own bloated weight. A state once held up as a model of innovation, growth, and real estate resilience is now teetering dangerously close to a full-scale housing meltdown. Number 7. Louisiana. Louisiana's housing market isn't just struggling, it's sinking, quite literally. In 2025, this isn't a typical downturn. It's a state in full-blown crisis, facing disasters on every front. From unrelenting hurricanes to skyrocketing insurance costs and a shrinking population, the foundation of Louisiana's housing market is crumbling fast. While the median home price sits around $265,000, that's about the only figure that hasn't gone off the rails. Insurance premiums have exploded, climbing over 50% in just 2 years, pushing thousands of homeowners to walk away entirely. Some carriers have fled the state altogether, leaving residents either completely uninsured or stuck paying upwards of $6,000 a year for the bare minimum in coverage. In cities like New Orleans and Lake Charles, the inventory of available homes has surged 31%, but sales have nosedived. The average property now lingers on the market for 85 days, the longest wait time in the entire South. And with nearly 30% of sellers slashing their asking prices, it's clear desperation is setting in. But even with steep discounts, buyers are scarce. So what's behind the vanishing demand? At its core, Louisiana's economy is under siege. Industries like oil, gas, and shipping, long the backbone of the region, are faltering under pressure from energy market swings, increased automation at ports, and a steady drain of residents moving elsewhere. In Baton Rouge alone, over 10,000 people have left in just the past 3 years. New Orleans faces its own battles. Crime is climbing, infrastructure is decaying, and flood risks are so severe that even developers are pulling out mid-project. Maintaining a home here is becoming a losing game. Maintenance costs have jumped 19% this year alone, thanks to intense heat, oppressive humidity, and endless storm damage. Add in flat wages, aging homes, and a collapsing insurance market, and you've got one of the most vulnerable housing ecosystems in the country. Not even federal disaster aid can stop the bleeding for homeowners drowning in both debt and floodwater. And this is just the beginning. As climate change accelerates, Louisiana's future grows more submerged by the day, both financially and literally. Coastal areas like Terrebonne Parish and Plaquemines Parish are being swallowed by rising seas, while the insurance market's collapse threatens residents statewide. Louisiana was once known for its grit and resilience, but now it's on the verge of a mass economic retreat. And when the full force of the housing crash hits, it won't just wipe out equity, it may erase entire zip codes from the map. Number 6. Arizona. Arizona's real estate boom once felt like it would last forever. For years it was the promised land, a sun-drenched escape for Californians chasing affordable homes, low taxes, and wide-open space. Cities like Phoenix, Tucson, and Scottsdale turned into migration magnets, but now, that dream is melting under the unforgiving desert sun. In 2025, the median home price across the state sits at $435,000. But don't let that number fool you. Affordability has all but collapsed. Living here is no longer cheap. Utility costs have exploded, with summer electricity bills now topping $420 a month on average, while water bills keep climbing as reservoirs shrink and droughts intensify. The market itself is shifting fast. Inventory has surged 25% compared to last year, and almost 27% of listings have already cut prices as buyers dry up. In Maricopa County, over 18,000 homes are sitting unsold, double what was on the market just a year ago. And with mortgage rates stuck around 6.7%, monthly payments have climbed above $3,200, pushing more and more families and retirees out of reach. And then there's the climate. Arizona is now averaging 35 days a year above 110 FEF, obliterating previous records. What was once a draw, the heat, is now driving people away. Climate migration is reversing, as residents flee not only record-breaking temperatures, but also water shortages, wildfire threats, and ballooning insurance premiums. Some of the fastest-growing suburbs, like Buckeye and Goodyear, are now littered with half-built homes and stalled developments. The local economy, heavily reliant on construction and incoming residents, is grinding to a halt. And that's the core issue. When people stop moving to Arizona, the entire real estate engine seizes up. Those who once fueled the boom, retirees, remote workers, and out-of-state buyers, are now listing their homes en masse, putting immense pressure on prices. As inventory floods the market, sharp declines are inevitable. The Arizona dream, the idea of cheap living under sunny skies, is over. What's left is a housing market that's overheated both figuratively and literally. And when the next economic shockwave hits, Arizona won't just cool off, it'll crash face-first into the desert floor. Number 5. Colorado. For years, Colorado's housing market seemed to defy gravity, soaring higher even when logic said it shouldn't. Cities like Denver, Boulder, and Fort Collins became hotspots for remote workers, deep-pocketed investors, and adventure seekers, all chasing the mountain lifestyle, no matter the cost. But in 2025, reality is finally catching up. The median home price has climbed to $580,000, while monthly mortgage payments have skyrocketed to an average of $3,950, nearly a 70% jump since 2020. That kind of spike has sparked a quiet but growing exodus of residents who simply can't afford to keep up. Housing inventory is swelling fast, up 30% year over year, and the luxury market is particularly flooded as wealthier buyers hit pause. In elite mountain towns like Aspen and Vail, multi-million-dollar homes now sit unsold for months, their for sale signs buried under literal snowdrifts. Investor interest has cooled dramatically. Construction of high-end homes has dropped nearly 40% since 2023, leaving entire developments in limbo. And it's not just real estate showing cracks. Colorado's wider economy is starting to buckle. Tourism, which normally brings in nearly $14 billion annually, is taking a hit from declining travel, intense wildfire seasons, and increasingly unreliable snowfall. Meanwhile, agricultural zones are grappling with worsening water shortages, slowing development, and pushing food costs higher. Places like Pueblo and Grand Junction, once seen as affordable escapes from Denver's price tags, are now struggling with rising homelessness and shrinking job markets. And it's not just homeowners feeling the squeeze, renters are leaving too. Rental vacancies are up 22%, the highest seen since the early 2000s. What makes it worse? The entire cost of living has exploded. Maintenance costs are up 17%, utility bills have surged 11%, and property taxes have climbed to historic highs. Life in Colorado isn't just pricey, it's punishing. The Colorado lifestyle used to sell itself: fresh air, solid careers, unbeatable scenery, but now even those majestic peaks are being buried under the weight of financial pressure. When the housing collapse picks up speed, this market won't gradually decline, it'll break loose like an avalanche, fast, destructive, and impossible to stop. The state that once symbolized outdoor luxury now stands on the brink of a financial landslide. Number 4. Hawaii. Hawaii might look like paradise on a postcard, but for those who live there, it's become financial purgatory. Beneath the palm trees and ocean breezes lies the most unsustainable housing market in the country. In 2025, the dream of owning a home in the islands has collided head-on with a brutal economic reality. The median home price across the state has soared to $875,000, while the average household income hovers around $88,000. That's a 10-to-1 price-to-income ratio, one of the worst ever recorded in U.S. history. For many locals, the idea of homeownership isn't just out of reach, it's a complete fantasy. Tourism, the heartbeat of Hawaii's economy, is stumbling. Inflation and global instability have pushed visitor numbers down 14% year over year, and once booming short-term rentals now sit vacant. As tourism contracts, so does the fragile demand that held up the state's housing prices. At the same time, insurance premiums are exploding. Over the past 2 years, rates have jumped 35%, fueled by rising sea levels, worsening storms, and climate-related threats. In places like Maui and Oahu, luxury condos that once sparked bidding wars now sit unsold for 120-plus days. Prices have already slipped 3.5% since the start of 2025, and experts warn that steeper double-digit drops are coming if the global economy falters. But this crisis isn't just hitting buyers. Renters are being crushed, too. In Honolulu, the average rent has climbed above $2,600 per month, and when you factor in groceries and utilities, residents are spending another $1,200 monthly just to survive. Hawaii's isolation drives up the cost of everything, from screws and paint to lettuce and milk. Maintenance costs have jumped 19%, and homeowners near the coast now face insurance bills averaging $6,000 a year, even for modest properties. Layer on aging infrastructure, unpredictable wildfires, flood risks, and a growing sense of instability, and the postcard-perfect lifestyle quickly becomes a financial pressure cooker. And when a recession finally hits, Hawaii's housing market won't gently deflate, it'll collapse. Locals are already leaving in record numbers, priced out and replaced by absentee owners and hollow luxury units that sit empty more often than not. In Hawaii, the American dream ends where the shoreline begins, because in today's economy, paradise is no longer made for the people who actually live there. Number 3. California. California once stood as the ultimate symbol of the American dream, a land of golden beaches, constant sunshine, and million-dollar homes that seemed to rise endlessly into the hills. But in 2025, that dream has unraveled, and what remains is a full-blown housing disaster. The state is collapsing under the weight of its own hype. The median home price across California is now a jaw-dropping $760,000, while the average household income stalls around $91,000. That's a price-to-income ratio above 8.1, and the numbers simply don't add up anymore. The consequences? They're already here. In this year alone, California has lost more than $16 billion in home value, with steep drops across major metros like San Francisco, Los Angeles, and San Diego. Over 30% of active listings have already been discounted, and homes are now sitting on the market for an average of 78 days, the longest since the post-crash slump of 2009. With mortgage rates above 6.6%, monthly payments have soared past $500 slamming the door shut on nearly all first-time buyers, and renters aren't faring any better. In Los Angeles, the average rent has surged to $2,900 per month, forcing tens of thousands of residents into debt, into overcrowded conditions, or out of the state entirely. But the crisis goes far beyond just housing. California is battling a perfect storm of social and environmental collapse, from rampant homelessness, rising crime, and drought to increasingly catastrophic wildfires, failing insurance markets, and a wave of residents fleeing for more affordable states. In 2024 alone, over 400,000 people left California, marking the third straight year of population decline. Major employers are also heading for the exits. Companies like Tesla, Oracle, Chevron, and countless tech startups have moved operations to states like Texas and Nevada, chasing lower taxes and less red tape. Insurance companies facing wildfire risk are pulling out of wide swaths of the state, leaving homeowners unable to get coverage or sell. At the same time, maintenance and utility costs have jumped 19%, and property taxes continue to drain thousands from household budgets each year. The government has made bold promises about affordable housing, but those efforts are too late and underfunded by billions. The hard truth? California built a housing system tailored to millionaires, not to working families. And now, that system is cracking open at every fault line. When the next economic shock hits, California won't just lose a little shimmer, it'll break apart. The Golden State is no longer a model of prosperity. It's a warning of what happens when the dream becomes unsustainable. Number 2. Texas. Texas was once the poster child for opportunity. No state income tax, affordable homes, and a booming job market that drew in people from all across the country. But in 2025, that dream is collapsing into a financial sinkhole. The median home price across the state has surged to $360,000, but affordability has completely unraveled. Property taxes, insurance premiums, and utility bills have all spiked, gutting the budgets of families who once moved here for relief. Texas is now staring down a projected $32 billion loss in home values, with cities like Austin, Dallas, and Houston leading the plunge. During the pandemic, Texas saw home prices skyrocket by nearly 60%, driven by a wave of migration and speculative buying. But now, the bubble is popping. In Austin, prices have fallen 8% in just 1 year, while housing inventory has jumped 26%, marking the highest supply glut in over a decade. Insurance costs are spiraling out of control, up to 40% increases, especially in coastal areas vulnerable to hurricanes. In Dallas County, property taxes alone rose 13% year over year. And those aren't the only costs crushing residents. Even Texas's once mighty energy sector is showing signs of stress. Oil prices are increasingly unpredictable. Renewable energy disruption, combined with manufacturing slowdowns, has led to widespread layoffs. Construction, once the heartbeat of Texas's economy, is slowing dramatically as projects are delayed and material costs climb. The climate isn't helping either. Brutal summer heat is making daily life more expensive and less tolerable. Average utility bills now top $420 a month, while maintenance costs have surged 18%. Pair that with mortgage rates around 6.8%, and homeowners in cities like Austin are now staring at monthly payments exceeding $3,400, a figure well beyond the reach of the average middle-class family. Here's the real issue. Texas built its housing boom on the promise of cheap living and endless population growth. But now, with affordability fading, migration slowing, and climate threats increasing, that foundation is starting to crack wide open. Analysts warn that home values in major metros could drop another 10 to 15% by 2026, and that might be a conservative estimate. Texas always claimed that everything was bigger, but in 2025, that includes the financial wreckage. The Lone Star State isn't glowing anymore. It's flickering under the strain of overdevelopment, environmental extremes, and a housing market teetering on the edge of collapse. Number 1. Florida. The illusion of paradise in Florida is unraveling, and it's happening faster than the coastline is eroding. Once hailed as the ultimate destination for post-pandemic migration, the Sunshine State has now become ground zero for America's next housing disaster. In 2025, the median home price across the state is around $410,000, but that's only the surface. Beneath it lies a web of soaring insurance premiums, skyrocketing taxes, and climate-driven costs that are choking homeowners. Florida's housing market has already shed an estimated $10 billion in value this year alone, with prices dipping statewide and steep declines reported in Cape Coral, Tampa, and Naples. Inventory has surged by 31% year over year, and 1 in 4 listings are slashing prices to lure increasingly scarce buyers. Homes now sit on the market for an average of 72 days, twice as long as this time last year. But the real storm isn't in the listings, it's in insurance. Premiums have exploded by over 300% since 2020, and several major providers, including Farmers and AAA, have pulled out of Florida altogether. In some cases, homeowners are now paying over $8,000 a year for bare minimum coverage, making Florida home to the most expensive insurance market in the U.S. Add in property taxes, utilities, and mounting climate-related maintenance, and some families are facing monthly housing costs above $4,000, more than double the national average. But this isn't just a financial meltdown, it's an environmental one too. Florida is on the front lines of the climate crisis. Record-breaking floods, saltwater intrusion, and Category 4 hurricanes have turned entire communities into uninsurable danger zones. Coastal erosion now threatens billions in property value, and summers are increasingly brutal, with more than 40 days a year topping 95 FF, even Florida's crown jewel, tourism is beginning to wobble, weighed down by infrastructure failures, rising insurance costs, and growing uncertainty. And the migration that once fueled the boom, it's rapidly reversing. People are packing up and leaving as fast as they once arrived. This isn't a gentle correction. The Florida housing bubble isn't deflating. It's bursting violently. And when the next hurricane or economic shock hits, the ripple effects won't stop at the state line. They'll be felt across the country. Yes, the beaches will still look beautiful, but for the millions who bought into Florida's dream, what's left is a financial nightmare, a sunlit trap where paradise has become a burden too heavy to bear.